We've all heard of FOMO, but I think what we're not aware of, FOMO goes in both directions. FOMO up and there's FOMO down. Why do we do this? When we see we're making loss after loss after loss. I remember doing this when I started trading, and I certainly had a lot of losses when I started. So why do we keep doing this? And that is the topic of my webinar, trading mentality and emotional management. Our bodies, our minds, we are machines. We need to devote time every day if we want to be a full-time trader. Trust me, I've stayed up all night, many nights in a row, watching candles. And it feels like that's the right thing to do. It just isn't. We're like a car. We need the proper maintenance. We need the proper care that keeps that machine working. You can't expect a car to keep performing without changing the oil. Regular maintenance. And that's the first step to getting into successful trade mentality. When you can get to that point where you are taking care of yourself, meaning getting enough sleep, taking time off, eating healthy, socializing with people, having a life outside of trading, outside of candles, you need a balance. Everyone needs a balance. I've spent way too much time personally not balancing that, and it's never led me to success. So that's part of what I want to share with you guys today. Once you can acknowledge that and internalize that, you can move on to the next steps of where are our shortcomings in trading. When you neglect taking care of yourself, you are putting yourself in a position to be very stressed, to be very reactive, honestly just to make poor decisions, to make bad decisions based on being tired, based on being stressed out by everything else. People don't sleep, they don't do whatever. You got to take care of yourself. And when you are taken care of, then you can start breaking it down. Becoming aware of emotions and understanding how these emotions influence your actions and how they influence your decision-making process. I think it takes a lifetime to master this, honestly. You can get into what I call as the trader's mindset. The trader's mindset is patient. The trader's mindset is calm, unreactive, calculated, and I think most importantly, it's confident. Understanding what you're getting into when you make a trade. I don't ever enter a trade unless I feel patient, calm, not reactive, calculated, and confident. If I don't feel all those things at the same time, I'm not going to enter a trade. I know that I'm not mentally prepared for it and that I'm probably going to make a bad decision. Everyone is susceptible to them. We are humans, and humans very much run by emotions. What are the motivating factors in a market? What are the motivating emotions? Fear and greed. Afraid of losing, or you are overly consuming of winning or profit. And I think most people will probably roll their eyes and say, oh, I know all about this, whatever. But I think it's really something that people overlook. They all kind of say, oh, I get it, check. I'm not that person, but everyone's that person. It doesn't matter if you are brand new to trading or have been trading for years. There is some level of fear and greed playing in every trade you make. A successful trader is one who can reduce the impact that fear and greed have on them. Fear is a natural response. We all have it to any perceived threat. It's basically hard-coded into our DNA. It's to protect us from danger. People feel fear commonly in trades, but it also can lead us to failure. Fear can encourage us to enter losses. This emotion is so prevalent in trading. Greed, much harder part to deal with, kind of counterintuitive. Greed is a good feeling, whereas fear is a negative feeling. And it's so much easier to allow a good feeling to kind of take over than it is a negative feeling. I think we all fight that naturally. But when we feel good, we really want to double down on it, own it, we want to keep it. And I think that's where new traders get really tripped up the most. It's driven by a desire to win. It's driven by ego. It's driven by desire to do better, to climb. When unchecked, can lead us to situations that are extremely risky. So both of these emotions are completely natural. You should not feel bad, or you shouldn't feel any negativity acknowledging that these exist within you, because they exist within all of us. And to some degree, they are unavoidable. You're gonna have an emotional reaction to everything you do, and you probably aren't aware that you're even doing it. By actively identifying these sources of fear and greed in our trading, I think we can improve as traders. When we're faced with a decision in the moment, Our bodies naturally hit that flight or fight reflex, and we pump adrenaline, feel like we have to make an action right now. FOMOing in and FOMOing out, buying on a pump or selling on a dump. It's an impulsive decision, and it is purely based in emotion. It's not based in logic. You can argue that it's going up, so logically I want to buy it, so it goes up. But it's not. You're in the moment, and your emotions are taking control of your logic, and your logic is thrown out the window. Number 2, position size is so important to trading. If your position size is 100% of your portfolio, you are going to have such an emotional response if it goes down. Even 0.5%, 1%, you're going to freak out because all of a sudden you're in this, again, flight and fight reflex. Number 3, new traders feel like every trade they do has to be all in, all out, 100% of their portfolio. They think that somehow one trade is all they need, and that's just not how it works. So the first step is to create a plan. Doesn't really matter what your plan is. It doesn't have to be the best plan. The most important part is to stick to that plan. And preferably, whatever plan you come up with is a plan you've created in the past. You have this ready. It manages your position size, and it clearly sets out your profits and your losses that are potential on this trade. Every single trade you make should have a plan before it's executed. It sounds simple. I'll tell you a secret. You cannot win every trade. You will not get rich off of one trade. It's kind of just a fairy tale. And I think it's a fairy tale we've all told ourselves and thought and believed. I have. Trading is 100% a marathon. It doesn't matter if you've won 10 out of 10 trades. It doesn't matter if you've won 20 out of 20 trades. It does not matter unless you plan on quitting right there. Like, you're ahead and you quit. I've never met anyone who stops trading once they're up, on a hot streak winning. I've just never heard of it. Like, we don't like to quit when we're ahead. We like to keep going. We keep rolling the dice. Hundreds, thousands of trades averaged out. And that's what makes you a trader. It's not, I made one trade and I won. It doesn't make you a trader. That made you someone who guessed right. Any kind of small sample size is just not indicative of any future results. It's about thousands of trades. It's about continuing to trade. Can you, out of those trades averaged out, continue to succeed? And I think that's something that people miss a lot. You'll all experience this. As you see this marathon keeps going, there are winning streaks. There will also be losing streaks. I think this is where a lot of people fall into the trap. Most new traders refuse to acknowledge that's not how statistics work. You might win 100 in a row, but then you might lose 100 in a row. They don't build into their plan the losing streak. If you're ever going all in on one trade where you're setting yourself up to potentially lose my whole portfolio. I used to do this and I got burned hard when I started trading. Straight up, I lost a ton of money. I learned my lessons. I learned by fire. I think we all learned by fire. When you open yourself up to 100% loss, you don't get another chance. Your portfolio's gone. You have nothing to trade with. Needs to be built in that you can lose over and over and over again and not be out. You need to hedge against ever being out, ever being zeroed, ever being done. When you're done or zeroed, you have no chance to get back in. My trades now, I limit them to maximum 2% of my portfolio total. That is a big trade for me because I've seen the win streaks, I've seen the losing streaks. At 2%, you can lose 49 times in a row and you're still in. Your plan has to account for every scenario. You can't just account for whatever you've seen continuing. This is not how trading works. What my plan has done is it has allowed me to continue trading because I know that if I lose a lot in a row, it's just a matter of time. First and foremost, protect yourself from being completely leveled. Number one thing to avoid in trading is the potential for total loss. If you roll the dice enough times, eventually you will lose, guaranteed. Slowly winning over time feels way better than losing 50% of your portfolio in one trade. Before every trade, we should calculate our risk and reward. We should have a take profit set. We should have a stop loss set. Ahead of time, we know what we're willing to lose and what our target is for gaining. I'm willing to lose $1 and I have the potential to gain $3. That's a 3-to-1 risk reward. You should calculate this out on every trade you make. And when you have that inevitable urge to change it midway because you think, oh, there's a candle that went against my trade, I should change this. That is emotions. That is a perfect example of your emotions interfering with your plan. By doing this, you're no longer making decisions in that moment that are fueled by emotions. You're never taking a risk that you're not prepared for. Measured it out beforehand, and over 1,000 trades, you're going to find that the average works out in your favor. Everyone trades differently. Everyone will have a different plan. Whatever plan suits you best, you need to be able to accept the loss. You need to be able to accept the gain. And if you cut one of those out, you're not going to get the other side of it. If you continuously change your trade as soon as it looks not quite the way you thought it would go, you're either going to take less of a gain than you should, or you're going to have more of a loss than you should. You made this plan, and in order to have it work, you need to stick to it. That's the only important part here. And by doing that, you've cut out pretty much all emotions. It's just numbers. You're not trading emotions, you're trading math. So my suggestion to people who don't have a strategy, dollar cost average. It's a great place to build a strategy from. It's simple, it's easy to understand, and historically it's been pretty successful. All you need to do is look at your budget, your money in, your money out. How much can you invest with no impact to your life? You need to be able to commit long-term on a fixed basis. This should only be money that you're okay with losing. People taking out loans to buy Bitcoin, mortgaging their house or something. There's no way any of these people ended up profiting. For every one of those, there's 100 or 1,000 or 10,000 people who did the same, and now their life's wrecked. How much do you need to invest? There's no minimum to investment, but there definitely is a maximum. That maximum is whatever you can't afford to lose. That's just going to pile on these emotions. It's going to make you fearful when it goes against you, and it's going to make you greedy when it doesn't. Making a buy, whether it's weekly or monthly or quarterly, it doesn't matter. Doing this smooths out your entry. It defeats the all-in mentality, and most importantly, DCA really involves no emotions. You're just making a buy on a timer. Someone who's DCAing, it doesn't really matter to them if it's a bear or bull market, because if the price goes up, they profit. They feel great. They have some euphoria. Awesome. If the price goes down and they're getting this thing at cheaper cost, they're getting more of it, they can root for the price going up or down. Really removes a lot of bias, and it just allows you to remain emotionally neutral. Really played the market in both directions. Once someone who is DCAing is in profit, they can also employ that the other way and start DCAing out. That's pretty much what I do, but I do it very slowly to avoid these emotional responses. Main points to take away here is I feel like we're our own worst enemies in trading, and we can get an advantage on ourselves by planning ahead because we can avoid impulsive moves, we can limit our losses, we can target our gains, and we will never invest what we can't afford to lose because we've made this plan ahead of time. So thanks for joining me, guys.